We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates. How are you today, Larry?
I'm great, Tom. Thanks for having me on. I always enjoy talking to you.
Absolutely. It's always great to sit down and chat with you. And, you know, I popped into a Twitter space this morning while I was prepping for today's interview and heard you talking and kind of sharing your thoughts about, let's just say, government statistics and GDP numbers.
Yeah.
So I want to get your take on, let's say, the conversation that you guys were having and where you stand on the reality or the feasibility of, let's just say, GDP numbers or inflation numbers, things of that nature.
Yeah, the most recent GDP numbers we all know was 4.9% annualized GDP growth, and that's supposed to be real growth, not, that's taking out inflation. Okay. However, that's also assuming inflation was only 3%, I think, or whatever they used to deflate it with. And what I would submit, and of course that deflation number is missing a lot of things like gasoline and food and some of the stuff that we all have to buy every day.
The expensive stuff.
Yeah, and so what I would right, the essential stuff. So what I would submit is that the government, the 4.9 number is just not a real number. I mean, we didn't add. I mean, growth ought to represent, if you're looking at an automobile company. If an automobile company grew 4.9%, you'd want to think the number of units you sold grew 4.9%. If you raised prices by 4.9%, you didn't grow. You sold the same number of cars at a higher price. And so that's kind of what I'm talking about here. I mean, I think the U.S. is saying, well, we had 4.9% growth in the economy, but I think, no, they really didn't. What happened is we had 7 or 8% inflation, real inflation. We reported 3%, and the difference got shown as growth. So yes, there's no doubt that the money was spent, because I'm sure they derive that from credit card data and a lot of other information. There was that much money moving around. The question is, was it really fundamental growth? And I would say no, it was inflationary growth. The numbers are bigger for sure, but they're only bigger because inflation is up, and we haven't used the correct inflation identifier. And as we all know, I mean, if you look at shadow government statistics, or you look at a number of other sources, I think it's the Chapman report. The inflation numbers in the U.S. have been cooked for years. I mean, they're not keeping them accurately. And I mean, this goes to everything. It goes to the employment reports as well. I mean, they have all these adjustments that they put in there. They don't really know the numbers. They put adjustments in, and then they backward revise them downwards after the fact. And so, I think one of the guys in the Bitcoin space talks about this a lot. I mean, Michael Saylor's like, these government numbers are all just made up. They're not real. I mean, it's maybe not quite that bad, but it's close. I mean, on the employment side, as an example, we show a very low unemployment rate, but we also have decided that a lot of people are no longer looking for work. So if you're discouraged, you get thrown out of the unemployed rolls, and you're just a discouraged worker. You're not an unemployed worker. So, I take all government information, data, et cetera, with a grain of salt. I mean, just as I take everything that we hear on the mainstream media with a grain of salt. I mean, there's an agenda being pushed by the people who are in control. And I don't think it's, wild conspiracy theory to suggest that the agenda isn't true in many, many cases. So, and that's just, as investors, that's something we've got to sort through, because, what is true is what's going to drive the investment outcomes, not what they say. Right.
Well, it's interesting. Exactly as you put that, Larry. I had a chat with Tom Luongo the other day on his podcast. I was actually the guest for the first time. Nice. And we talked about, the idea of podcasting as a medium right now, and how important it actually is because of the narrative that we're being fed. And I think this growing number of people that are waking up to the idea that we're just being spoon-fed a narrative that is simply not accurate, right?
Absolutely.
If we take growth in GDP, for example, but we don't include gasoline and food prices and these other pieces of that puzzle that really make up a lot of people's everyday costs, maybe technically that statistic isn't a lie, but it's also not representative of the actual
it's very misleading
economy.
It's very misleading. I mean,
to be able to understand that is paramount right now.
Yeah, and I mean, and that's why I think what you do is wonderful. I like Tom Longer a lot. I think, I mean, look at like Joe Rogan. I mean, one of the beautiful things, I mean, there are a lot of things going on in the world that aren't so great, and there's some things that are going on in the world that are wonderful, but, there's always a spectrum. You can look for the good or the bad. But one of the things I think that's going on that's wonderful is that these big sclerotic, top-down media organizations and governments are being disintermediated and kind of destroyed by the internet. And the fact that Joe Rogan can have more listeners than CNN, or that a Tucker Carlson can leave, Fox and just bury them in terms of, number of people who are listening to him, because I think in general, most people, average people, they want to try and seek out the truth and hear the truth. And, pre the internet, the truth was what the New York Times printed. And, sadly, the New York Times has strayed from the truth. And a lot of people have discovered you've got to go, to direct to the sources to get a true story of what's going on.
Well, it's almost like you have to get 2 or 3 different sources to try and figure out what the real story is.
That's right. And look, there's nobody saying that everything on the internet's accurate as well. I mean, there's a lot of bullshit and noise and so on and so forth. But I would submit that, thankfully, think of how it is today versus, pre this medium existing. I mean, the fact that the internet exists and that YouTube exists and that we can all communicate more directly, and that somebody can have the same, I'm as accessible as the New York Times to anybody if they just have a computer, right? So it's a powerful thing. It's a powerful dynamic. It's going to change the world in my view, in a very good way, because people are going to wake up and demand that they have representative governments that are more honest than what we've got. And of course, that's a low bar to step over because they're also dishonest.
So, Larry, we're speaking here on November 1st.
Yeah.
And I think there was a lot of people expecting something dramatic to be broken during, let's say, September, October. And I was laying in bed this morning thinking, everybody expected something dramatic to happen here. And I wanted to get your thoughts on the lack of drama and the apparent stability in the markets right now. And what is actually going on underneath the surface, these pieces of the puzzle, as you say, the rivets popping.
Yeah, that's a great question, Tom. And so as you know, my view is that, the financial markets are badly broken, and a lot of things are very badly mispriced, and that we're running into a sovereign debt crisis, and which will ultimately become a currency crisis. So that's kind of the big picture. And the first evidence of that was in March when the Silicon Valley Bank blew up, and then they came in with more quantitative easing. They called it BTFP, but it was the same. And so, the problems are there. This reminds me of 07 or 08, when in 07, the 2 Bear Stearns CDS funds blew up. In 08, Bear Stearns went bankrupt. Financial crisis didn't happen until August, September, October of 08, but it was coming. And the rivets are popping, and you can see that now. And you're right, it's kind of calm. But I would point out a couple of things have happened this fall that I think are meaningful. Recall that we had a huge, the peak of the bull market was December of 2021, right? To me, that was almost a crack up boom. Everything was going berserk. Crypto, you name it, it was going up. And it stopped. And Powell came in and started raising rates, and all of that stopped. And we got a serious correction in 2022 in both bonds and stocks, the first time that had happened in many, many years. And then, of course, we've got a bounce out of that, at least in the stock side, not so much on the bond side. And that bounce was going on through, I'm just looking at my screen here, through kind of July of this year. And we had recovered a lot of the 2022 damage. So all those people who bought at the bottom in 2022, sure enough, buying the dip was the right thing to do. All my neighbors who I told to sell their Google and Facebook and so forth, they didn't do it. And they were rubbing it in my face this summer. But, since then, market's down, not a ton, but it's trending down. And probably more importantly, or as importantly, the bond market's down too, and interest rates are going up. And so what I think is going on is more and more people are starting to recognize this issue that Lynn Alden and Luke Gromen have termed fiscal dominance, which is to say there's a government doom loop taking place where higher interest rates drive higher interest costs for the government, which then increases the deficit, which then means they need to sell more bonds, which all other things being equal, the supply of demand, the demand for bonds being fixed leads to higher interest rates, which then leads to higher deficits, and wash, rinse, repeat. And you can see where this ends. It ends with the government, quote unquote, losing the long bond market because nobody's willing to finance a government that is demonstrably bankrupt. Mm-hmm. And, they could change this. I mean, they could get fiscally responsible in Washington, D.C., but, you laugh, you smile, and that's because we all smile, because that's just not what we see. I mean, we saw Biden recently saying we need 50 billion for additional here and 100 billion for additional stuff there. And so, and they're throwing around these numbers like, it's just manna from heaven. And of course, they can do it because they have control of the government system and they have control of the printing press, but they do need to sell bonds in order to do it. And eventually the bond market's going to say no mas. And the bond market's kind of started saying no mas. I mean, the 10-year hit 5%, it's backed off a little bit. It's very oversold. It wouldn't surprise me if it bounced here for a while. But I think in general, the story of our age right now is that the government bond market the U.S. federal government is in trouble financially. Mm-hmm. And that's a sovereign debt crisis. And so they're faced with the issue of, do they want to save the dollar or do they want to save the bond market? And basically Powell is trying to save the dollar by pushing rates up and pushing, to counter inflation, and the dollar has rallied. The dollar's been very strong in the last 4 or 5 months. So, on the other side of the table, Yellen and more realistically, Congress and the Senate, they're not doing anything to rein in the spending, and these wars don't make it any easier. And so, as a result of that, you've got, as I just described, this doom loop taking place, and something's got to give. If Powell prevails, we'll have a downturn that'll make the Great Depression look tame. And if he doesn't, we're going to have they're going to have to pivot, and as they pivot, we're going to go back and get the next wave of inflation, which is kind of what I see is coming eventually. Because to me, and I said this constantly, I mean, to me, this decade is going to look like the 1970s on steroids, which is stagflation. Economy is going to be kind of punk, but inflation is going to be really, really a problem. That you just can't have 40 years of deflation from 1980 to 2020. And then, you have a little bit of inflation from 2020 to 2023. And okay, it's all good. We're fine. All that misallocation, all that 0% interest rate, all that everything bubble, that's fine. Don't worry about it. We're going to go back to normal. I mean, and that to me is the mistake that most investors are making, is they're investing in the rearview mirror. I mean, and it's very hard. It's a natural human bias to, you kind of do what has worked. And since 2008, what has worked is believing in the system and buying the dip, and assuming that, they'll get inflation under control. And you see this, another place you see this, Tom, is in the 5x5 swaps, which you can get on Bloomberg. It means 5 years out, people for the next following 5 years. So from 5 to 10 years out, the average bet is that inflation will be 2.7%. So that we're going back down to low inflation days. And personally, I just don't think that's likely to happen. I think that, there are a lot of structural reasons why that's unlikely.
Well, I think to your point, Larry, when we're talking about inflation, I saw a story, I think it was yesterday. This labor dispute was finally resolved with GM, right?
Right.
They're going to be getting a 25%
bump
rate increase over the next 4.5 years, only adding to inflation again, right? That's only going to end up driving the prices of cars. So if you divide the 25 by 4, so maybe that's 6% a year, that's a lot more than 2.7. And I thought the other thing in there that was actually more troublesome was that I guess they didn't have COLA, cost of living adjustments in the deal before, but they got COLA adjustments. So they've got at least 6.5% a year for the next, X number of years, and a COLA adjustment. Well, guess what? I think it's pretty safe to say that Ford and GM and all the companies that, our cars are going to cost more. Mm-hmm. And that's the kind of thing that I think is going to happen. It's happening everywhere. It's going to happen in the oil market as well. I mean, I was just on a Spaces with Lynn Alden, and she was pointing out that,
we have underinvested in all of these commodities, through this great everything bubble where all the capital went into the FANGs and the Magnificent Seven and the stock market. Commodities got left for dead because we had a lot of supply and prices were under control. But, by not investing in those commodities, we're paying a price now. And I think oil prices are going to be very sticky to the downside. And, we're at $70, $80 oil. I mean, imagine what happens when we're at $90, $100, $150 oil. I mean, I was in California a month or so ago and the gas prices were like $6.50. It's just right. And so that, to me, we live, the tide has turned on inflation. And I think that's they say in investing, what you want to have is the deviant perception. You want to understand something that the market doesn't fully understand. And it's my belief that the market doesn't fully understand how big a problem inflation is going to be in the next 10 years. Mm-hmm. And that therefore, if you want to outperform the market, you need to find investments that take advantage of that fact, or what I believe to be fact. Now, if I'm wrong about that, obviously my investments aren't going to work. Mm-hmm. But assuming I'm right about that, I think that, the best way to do it is to head to sound money. So.
Well, I'd like to get there, Larry, but before we do, I want to go back to the idea of the government issuing more and more debt. It kind of seems reminiscent of the situation that Japan is now in, where they either sacrifice their bond market or sacrifice the yen. So this kind of brings up the idea that obviously China has been selling treasuries. Brent Johnson had a big thread about that the other day. And I just wanted to get your take on the overall debt situation and what the demand for U.S. treasuries ends up meaning for the U.S. And if it ends up being the rest of the world's problem before it really becomes the U.S. problem because of that demand for trade in dollars.
Yeah, those are great questions. And it's a very interesting observation. I was listening to Luke Groman the other day, and he said, I buy Brent's theory about the milkshake theory that these other countries should get in trouble first, that the dollar will be the last currency to hyperinflate. But then I listened to Luke talking about it. He said, okay, well, if that's the case, then why did Silicon Valley blow up? And we haven't seen any blowups in other countries. And I was kind of like, oh yeah, you got a point there. It's tricky. I mean, and I've had other people say, well, look, Japan has pulled off this QE forever. Their debt to GDP is 229%. They haven't had any problems. Well, a couple of things I would say to that. One, I get this on Twitter a lot. I mean, one, I would say, look, Japan runs a net trade surplus, big one. Okay. Two, Japan is a nation of savers. We are not a nation of savers. And Japan has a huge net international investment position. In other words, they own a lot more of the rest of the world than the rest of the world owns of them. So if they have a need, they can sell assets to defend their currency, and they will. They'll probably sell treasuries. In fact, they have been selling treasuries. So the macro flows are really, really tricky and hard to figure out, and they're probably even above my pay grade. But I think it's safe to say that the U.S. with the world's reserve currency behaving the way we're behaving, with the expenses that we're running and the deficits that we're running, you're clearly seeing something has changed. And let me point to why I make that statement. As we all know, we've raised rates from 0 to 5+%, right? That should have hammered the shit out of gold. It really should have. I mean, that's a big move in real rates. And if you go back and you look at a 15-year chart of real rates and gold, they track really closely, okay? But it hasn't. And the reason it hasn't, in my opinion, is that gold smells what's coming. Gold is looking around the corner and saying, okay, yeah, you've raised these rates this high, but this isn't going to last because, we know we've seen this movie before, and we know that when enough of these rivets pop and something breaks, you guys are going to pivot. You're going to go to QE. Your balance sheet's going to go from 8 trillion to 20 trillion. You're going to send out, stimmy checks the way you did with COVID, et cetera, et cetera. And I think gold smells all of that, but it hasn't happened yet. And that's why it can't get through the ceiling around 2000, 2050, 2070, somewhere in there. So, but I think the math is so compelling, Tom, that look, and this is in my quarterly report, which I encourage people to go to my website and read. It's free. We're spending about $1 trillion, the U.S. federal government spending about $1 trillion a year on interest expense right now, $1 trillion. Okay. And we're running a deficit. We just ran a deficit of 1.7 or 2, depending on it was going to be 2, but they took out the student debt. So it's 1.7. Okay, fine. So, over half the deficit is kind of the interest expense. That interest expense is at an average rate of 2.5%. And most of it's front end loaded. Okay. Most of it's in the 3 to 5 year category because she never termed it out. So with that as a backdrop, imagine, and right now, if you go and look at the US Treasury curve, everything in the short end is at 5. Okay. So what that suggests is that if all else being equal, if interest rates stay just where they are now, they don't even go higher, which I think they will, but let's just say they stay where they are now for the next 3-4 years, the U.S. federal government interest expense is going to go up to 1.7, 1.8, 1.9, 2. So we're going to add another $1 trillion in interest costs. And that's, and then by the way, the debt, which is now, was it 35 trillion roughly? I mean, at $2 trillion a year in deficits, add another 3 or 4 years on there, we're going to be at 40, right? Mm-hmm. So it's like, okay, I mean, it really is kind of a death spiral. And, this is not unusual. Okay. I mean, we look at this and I think a lot of people don't want to look at it, although you see guys like Druckenmiller and other smart investors now starting to recognize it. But, this has happened in third world countries before. This is not unusual. It's unusual to be happening in the biggest country with the biggest military with the reserve currency. That's unusual. Okay. But it's not at all unusual to see a country spend too much and try to deal with that by, supporting their bond market and printing the interest on their bond market and printing the money in order to continue the spending. That's very common. That's happened in Argentina. That's happened in Venezuela. It happened in Brazil. It happened in Weimar Germany. It happened in Zimbabwe. I mean, we can go through the list of Czechoslovakia. It happened in the countries after World War II. I mean, there are lots of instances of third world and other countries that have had sovereign currency crises. That happens. The difference is that this is happening at the U.S. level. And I think obviously those of us in the sound money community understand it, and we're kind of screaming at the top of our lungs about it. And a lot of people think we're nuts, or, I get accused of being a doomster. And, look, I don't like any of this, and I'm not trying to be a doomster. I'm just trying to analyze what I see and suggest that, my analysis tells me that we are running into a trap that's going to create a lot of trouble here. So that's kind of, the bigger picture.
Well, I want to go back to the point you were making about the banks. That's another one of the rivets popping as you wrote in your quarterly report, which I read all of them. They're excellent. Thank because you. it just walks you through exactly what you're thinking and seeing here. So how are the banks going to be able to continue to weather the losses that they're taking? If we go back to that. If we go back to that chart from your quarterly report, it's dramatic. That's
a great question. I mean, it's been estimated that so Silicon Valley Bank failed, First Republic failed, some other big banks failed. The government came in and for a while, Yellen was talking about guaranteeing all deposits. I mean, there's 17 trillion of bank deposits in the United States. I mean, the FDIC's got a couple $100 billion under management. So if all the banks were starting, the FDIC would very quickly get overwhelmed. And by the way, in Silicon Valley Bank failing, Black Letter Law Dodd-Frank said that the depositors should have taken a hit, but of course they didn't, because all the depositors were well connected and politically connected, and they got these organizations to step in. They changed the rules, as they always do, our corrupt government. But anyway, so the Silicon Valley Bank, that was the tip of the iceberg. That was the biggest, most noticeable one. There are about $600 billion of mark-to-market losses, perhaps even more, because the numbers that was computed on are, I think, from July, in the commercial real estate market that are generally speaking held by regional banks. And I saw a good report about a month ago that showed that if you marked all the commercial real estate in regional banks to market, over 50% of the regional banks in the United States would be underwater. In other words, they would have negative equity. And that problem is just starting to come to the surface because it takes time for that debt to roll over at higher rates and for the keys to get given back on those buildings. But if you check my Twitter feed, a day or two, I talked about, there was an instance in there, a good tweet from a guy who said, there were 10 commercial real estate loans that came up for renewal, and in 9 cases it was a default, and they gave the keys back to the building. Well, somebody's taking the loss on that building, right? And it's the commercial bank that holds that note. And so yes, what you've alluded to is that there's a big problem brewing in the U.S. commercial banking system at a regional level. And I don't know, the BTFP helps a little bit, but I'm not sure if it's going to help enough. And, it wouldn't surprise me to see Yellen eventually having to go to, that we are going to guarantee all of these depositors, because it's one thing when you have losses. I mean, Silicon Valley Bank, the reason the losses occurred there was because they had bought U.S. Treasuries, which were definitely money good. I mean, the government's going to pay back their bonds, but they were marked way, way down because they were at low interest rates, and interest rates had gone up a lot. That's a different animal than a guy who borrowed a bunch of money against a building. And there are many stories like this where, the building was worth $100 million. The guy put up 20, he borrowed 80, and now it's worth 40. And so the bank, the loan comes up for renewal, and the guy says, sorry, bank, it's yours. Here are the keys. He takes his loss, and the bank now has an $80 million loan on a building that's worth 40. Mm-hmm. And so they have to market to market. They got to sell that building into and by the way, as more of them come, that 40 might become 30 or 20 because there'll be a lot of supply. As we all know, we're all doing Zoom now, so there's less need for commercial real estate. Mm-hmm. So that's going to be a problem, and it's coming. And you can just see it coming. And so, the problem here, again, Tom, 0% interest rates from 2008 to 15, and then a little bit of a break, and then they brought them back with the repo blowout in 18, and then they really brought them back with COVID, right? All of that free money created enormous bubbles in all of these assets. And the bubbles have been popped. There's no doubt. There's no way we reinflate them, right? And so the air has got to come out of those bubbles. And let's just review bubbles and what generally happens when the air comes out. There was a bubble in the .com and NASDAQ world in 2000, right? It got popped. The NASDAQ index from the top in 2000 to the bottom in 2002, it went down 80%. The bubble in 1929 was in the Dow and all the stocks, and there was, they were using all kinds of leverage and margin loans on these stocks. That thing went down 80%. This bubble was as big as either of those two, in my opinion, perhaps even bigger. Mm-hmm. And so a lot of things need to come down in price by 80%, right? And the Fed will, once they realize that's in process, and right now they're reacting to the people who are screaming the loudest, which is the political base screaming, as they should, hey, we're getting eaten alive by inflation. This really sucks. You grew the money supply 40%. My gasoline is twice as much, and I'm not getting paid anymore. God damn it. If you don't solve inflation, we're going to throw all of you out. Okay, fine. They're trying to solve inflation. You watch how quickly the narrative changes to, Jesus, I lost my job. This economy sucks. Oh my God, my business is failing. Bankruptcies are going up. My house is down in value. I can't pay I can't pay the new higher interest rate on my HELOC. I mean, and when that becomes the bigger pain, when more people are bitching from that than they are from inflation, and by the way, inflation won't have been totally solved, but it'll be a little lower, then they're going to pivot to, oh shit, we went too far. Mm-hmm. We got to stop this QT. We got to stop raising rates. We got to drop rates, and then we got to go back to QE. But by then it'll be too late. And the cycle will be, what people don't understand, anyone who had economic macro econ 101 or took a banking course understood fractional reserve and the money multiplier effect. And it works great on the way up, and it feels good when prices are going up, right? But it works the same way in reverse. And, we are on the backside of that curve now, and it's not over. Mm-hmm. We're not even close to being over, in my opinion. So, the way one has to protect oneself is to have assets, in my opinion, to have assets that can't be printed. Now, I was listening to Lacey Hunt, and he said, hey, look, maybe even if they print, it's not going to be enough. It doesn't matter. We are headed for a total outright deflationary bust all out of the 30s. And that could be the case. And if it is the case, that's rather scary for all of us. But my sense is that based on the policy response, even if we get that, I think we're going to have kind of biflation, which others have used that word as well. which is to say, I think asset prices are going to go down. Real estate building prices are going to go down. High-end housing prices are going to go down. Anything that was puffed, stock prices in general are going to go down. Anything that was puffed up by free money, it's going to go down. But the stuff you need, gasoline, food, the stuff you're going to buy no matter what, because you need it to stay alive, that's not going to go down.
No.
That's going to keep going up because there's, it's not like we have more supply of it. And there's going to be more money chasing it because they're going to be printing more money and injecting it into the system. I mean, at the extreme, if this downturn gets bad enough, we've already seen the model that they'll use. They used it in COVID. They sent stimmy checks out. Hell, California was talking about sending stimmy checks out to deal with high gasoline prices. So we know what the politicians will do. And, it's just a matter of kind of watching it unfold. And, it takes some time. I mean, I have to confess, I am surprised by how much the economy has held together. I don't think it grew 4.9% last year, but the layoffs still have been relatively tame, and things are kind of hanging together. Of course, when you run a big budget deficit, and and there was a lot of money printed before that, it takes a while for the ship to turn, but it's turning, in my opinion.
Mm-hmm. Well, Larry, when we're thinking about all of these things together, and you say that the Fed is going to pivot, go back to QE, stop QT. I asked Danielle DiMartino Booth this the other day, and a couple other people in the recent past here, and I want to get your take on the idea that Powell's legacy is very important to him, obviously.
Oh yeah.
Danielle brought up that the other day that I believe it's something like we're 4 months away from the amount of time that Larry, remind me of that Volcker was hiking rates for. So
yeah.
Do you think that Powell ends up resigning before we go back to QE because of the importance of the legacy and his stance on higher for longer?
Yeah, that's a great question. Boy, that guy puzzles the hell out of me. I mean, he really does. I mean, I don't. Mm-hmm. First of all, if he'd had half a brain, he wouldn't have taken the second term. He would have let somebody else deal with it. But because it's a lose. He's in a lose-lose no matter what. Mm-hmm. I think and I don't know what kind of a person he is. I really don't know much about him. But if he were an honorable person, in my opinion, one of the things he should have been doing all along is chastising Congress and just saying, guys, you're putting me in it, because Congress is the addict, the spend and increase the debt addict. But he's the dealer, right? I mean, he's the guy giving them the free money and allowing them to do it. And so he should have been saying something to him. But, to me, the honorable thing for him to do would be to say to Congress, you guys got to stop this shit, or else, and or to resign to maintain his legacy. My guess is he probably has enough ego and may feel enough sense of duty that he'll do the pivot and justify it and try and sweep it under the rug. I mean, it's amazing how they don't get called on the statements and the things they've done that are wrong. They just kind of reinvent the narrative and go on to the next move, right? Mm-hmm. And so, they say, well, it looked like the right thing. Raising the rates as high as we did looked like the right thing to be doing at the time. Just like he was saying,
we were data dependent.
Yeah, it was data dependent, right? We got new data. Well, we're going to change to go this way now. So I don't know. I can't game theory how he's going to play this or what he's going to do. I do think some people think he's determined to just run it right into the ground, that, to maintain that legacy, even if it means an economic depression. I think the political pressure on him would be so high and so awful that he will at some point be forced to pivot. I mean, the other, he does have 12 other members, and if they're all, or 11 other members, if they're all screaming at him and I mean, he'll find a way to justify what he's got to do to keep the system going. And because remember, I mean, their third mandate is to keep the system going. And, at the end of the day, all of these people do get, like Hank Paulson begging Nancy Pelosi, they get down on his knees, look, you got to give us TARP or else the ATMs aren't going to work in the morning. Mm-hmm. And so, and there's always the risk of kind of a financial collapse / full meltdown. And I suspect that, if Biden and the other 11 governors were telling him that, he would have to cave, and he would. So, but he'll probably cave before we get to that stage. On the other hand, it's as we've seen, markets can move really, really quickly and really, really aggressively. I mean, there's a scenario, right, where gold breaks out and shoots up to 3,000. Bitcoin breaks out and shoots up to $100,000. The long bond goes to 7% quickly. All three of those things happen really quickly. I mean, kind of like recall about a year ago in September of last year, this was happening in the UK gilt market. Remember? So, the dollar, by the way, the dollar would be sliding hard too. The UK gilt market blew out last year. I mean, rates went straight up and the pound went straight down. And they were trying to do quantitative tightening and they had to quickly reverse their policies and go back to QE. And we saw this, in 2020 or the repo blowout. I mean, that's the thing. What people don't understand is the system is incredibly fragile and we've had all these clues. I mean, the repo blowout, that was a huge clue. The UK gilt thing, that was a huge clue. COVID was a huge clue. 2008 these things continue to occur on a regular basis. Silicon Valley Bank was a huge clue. I mean, they've all, and we know, what do they do in Silicon? And with each of these clues, what did they do? They caved and did what they had to do to keep the system together. Mm-hmm. So that's why I strongly believe that as this next chapter unfolds, they will cave and do what they have to do to keep the system together. That's the good news. The bad news is that will be enormously inflationary. And, we will have $10 gas and $3,000 gold and, so on and so forth. Right.
Yeah. I mean, to exactly that point, this idea that you want to own assets that aren't printable, that aren't
correct,
easily replicated like this. I don't know that we want to live in a world where we have $5,000 gold, right?
No, I don't think none of us want any of this, but sadly, it's the way the system is constructed. I mean, what we're seeing here is the endpoint of a 40-year Keynesian experiment, since we came off the gold standard in 71. And the amplitude and frequency of the changes, the frequency is getting smaller and the amplitude is getting larger. Right. And it's sad. And, like I say, I get accused of being a doomster and I'm not. I'm just looking at what I see, and what I see tells me that, the problem is there. It hasn't been fundamentally solved. I mean, we've always been trying to solve a debt problem with more debt. And, what is it? Herbert Stein said it, right? If something cannot go on forever, it will end. Stein's law. And you just can't keep borrowing your way into prosperity. It doesn't work. Eventually, something's got to give. The currency has to collapse or the economy has to collapse, because there are too many commitments against too few assets that have that kind of value.
Mm-hmm. Larry, I'd like to touch on a little bit more or talk a little bit more about the idea that gold is really sniffing out what is going to happen here. It's these high rate environments are typically or let's say historically bad for gold.
Yeah.
Yet it's at least been hanging in there. So
in the dollar, and by the way, in every other currency, it's making new highs except the peso. For some reason, the Mexican peso has been very strong. But set that aside. I mean, I put up charts on my feed on Twitter all the time. I mean, it's making a new high in the yuan. It's making a new high in the euro. It's making a new high in the yen. I mean, every other currency, gold in every in the rupee, gold in every currency, the ruble, gold in every currency is making new all-time highs. Full stop. It hasn't quite made one in the dollar yet, but it's very close. I mean, I think the intraday was 2070. I think high close was 2050. We were over 2,000 earlier this week or late last week. We're now under 2,000 again. We're in 1980, 1990 right now, somewhere in there. It's not far away. We're within 4 or 5% my view is when we take out 2,100 with authority, we're going to squirt up to 25 or 3,000, and the miners are going to go, berserk. They're going to do a rocket ship launch. Mm-hmm. But to me, the reason this is occurring is that more and more people are becoming aware of the problem. I mean, Tom, the number of people in the world that are aware of this problem is very low. But yet we had record third quarter gold purchases by central banks, just on Twitter, just this past quarter. And in turn, we'll probably have another record year and 22 was a record year for central bank gold purchases. So, some piece of the world is coming to see that this asset, gold, is better than sovereign bonds or sovereign currencies, and even better than stocks. I mean, that's the thing that's, until recently, the stock market, really represented a big competitor to gold because, why not? You just buy the stock market and you get, 15 to 20% a year. But that all ended in end of 2021. It went down hard in 2022. It's come back, but now as it starts to roll over again, I mean, I think, and as you know, investors chase performance. I mean, I couldn't find anybody to invest in my fund in 2018, right before it went up 4x.
Yeah.
And by the way, I had a ton of investors come in 2020, right before I've given half of that back. So, people chase performance. And so once gold breaks out to a new all-time high, you're going to get a lot of people who are going to say, oh, that means something. I got to go get some of that. Mm-hmm. And, there's a way this doesn't work, by the way. I mean, to be the devil's advocate here, if the government suddenly gets responsible, then this isn't necessarily what we want to do. Right. You laugh, and I do too. And most people do, because it strikes me and all of us that the odds of that are rather low, but they're not zero. But perhaps as the problem gets worse, they'll realize they've got to get responsible, or else they're going to blow up the world. Right. But,
if they fall out of bed one day, hit their head and say, oh, we need to fix this problem, how do they get around the actual, as you say, the mathematical piece of having this much debt at this point?
Yeah, it's pretty tough, because if they cut the budget substantially, that throws us into a recession, which then brings down tax revenues. I mean, boy, I don't know. They'd have to increase taxes. I mean, they'd have to go, I think they should get rid of the income tax and go to a VAT. And make, and exempt food, because everyone needs to eat. But basically, we all pay a VAT on stuff that we buy. My view, Tom, is what they really should do, and Groman's laid this out nicely a couple of times, they really should do a reset. They should do a monetary reset. I mean, this is what Roosevelt did in 33 and 34. They should basically say, look, we've screwed this thing up. We've got way too much debt. We don't have a balanced budget. We're going to pass a balanced budget amendment. We're going to revalue the dollar in gold terms. We're going to start to buy gold for the country. We're going to take the 261 million ounces that the U.S. holds and market to market. And by the way, the new market price for gold is $25,000 an ounce, which is kind of the low end that Groman calculates. And I agree, it could be as high as 80. But at $25,000 an ounce, we're going to buy and sell gold, and if we can't print gold, and so there will be the number of dollars that are outstanding based on the amount of gold we have. Full stop.
Yeah.
That would stop inflation dead in its. I mean, it would be a big one-time inflation, and the price of everything would be up substantially. But at that point going forward, that would stop inflation. There've been a lot of hyperinflations and serious inflations throughout the world, and they're painful and they're bad. And yet, after they're over, when you do the reset and you peg things to a sound money like gold, things improve quickly. Mm-hmm. As I've said this many times, I mean, we got great people, we got great technology, we got great natural resources. It's a great world in a lot of ways. And if we can manage to not blow ourselves up in a fourth turning World War III, which sometimes I worry they're going to start one to cover all this shit, but if we can manage to avoid all of that, we return to a very equitable and good system. I think a lot of the problems we have would disappear. But sadly, the politicians that we have in power right now have no idea that this is even an issue, much less how to solve it. Mm-hmm. So, like so many things in life, I think we're going to have to fuck around and find out, right? They're going to keep doing what they're doing, and sadly, it could get it'll be a little bit messy before we get to the right solution. So,
Larry, you brought up the phrase chasing performance, and I remember, within the past year here, there've been a couple people talk about the idea that when the stock market isn't really showing these returns, that hedge funds and institutional buyers are going to have to come into the gold market they're going to be forced to come into the gold market
Yes.
just because of the relative outperformance of the metals versus, let's say, the stock market. So
that's exactly right.
I don't think that really happened in any way, in any dramatic fashion, but yet we see the buying by central banks. So are they really the first ones leading the charge in that direction?
Yes, I think the central bankers, the smart central bankers, see it, realize it, understand it. And by the way, I mean, let's talk about one thing that obviously drove a lot of that as well. I mean, the United States, I mean, say what you will about Russia and the horror of their starting the war and all that other stuff, seizing $600 billion of assets of a sovereign country. I mean, really just stealing them and saying, hey, you started this war, we're taking all your money.
Yeah.
I mean, that was a really stupid move. I mean, that was a complete bonehead move, because what it said to every central banker in every country in the world is, if the United States doesn't like your politics, they can grab your money. So, gee, why should we hold US dollar reserves? Gee, why should we hold US bonds? Gee, why should we use the SWIFT system? Why not deal with each other directly? Mm-hmm. And all of that has been very adverse to, the United States, and will continue to be adverse. And I think that's another reason why these central bankers are buying gold. But yeah, I mean, it has not happened at all, I can assure you, Tom, in terms of in the investment community, certainly not with the gold stocks. I mean, there was a couple of years post the COVID money print-a-thon that drove them up quite, aggressively, but they've given half of that back. But this is the way these things go. I mean, markets move in waves. You get a wave up, and then a wave back, and a wave up. And, I remember very clearly in 2018 thinking to myself, is gold ever going to get through 1365? We're stuck at 1365. Drive me fucking nuts, right? And, sure enough, it did. And sure enough, stuff took off. And, we're just in one of those down waves right now, and it's very depressing for gold stockholders. I mean, good God, we've been getting kicked in the face here for 3 months or 3 years, but the stuff is silly cheap, and we can see what's coming. So, and as that comes, and as we start to put up those numbers, yeah, I mean, an asset manager that doesn't have a decent piece of their assets in commodity related, it's not just gold and silver. Mm-hmm. I mean, it'll be copper, it'll be oil, it'll be lithium. I mean, all of these areas, everything in life is cyclical, and all of these areas we've underinvested in because we had this low inflation, deflationary environment where long duration technology assets, which threw off cash, look like the best assets to own by far. And they were, as long as we were in a deflationary environment. When we turn to an inflationary environment, that all changes. Mm-hmm. It completely changes. Those PE multiples are going to contract. The stock market to me is an accident waiting to happen. I mean, the thing to keep in mind is, we're trading at peak multiples and we're trading at peak profit margins in these companies. And yet all the employees in these companies are getting squeezed by inflation. And so they're doing what the UAW did. And they're going back to their companies and saying, give me a raise or else I'm going to strike. Mm-hmm. And the company is going to give them the raise, and that's good. But the problem is the company's not necessarily going to be able to increase their pricing. And so their margins are going to go down. And so now you've got a lower margin, and then the PE multiple is at a peak. Well, guess what? Now that you've got bonds and other things competing with it, maybe, your earnings yield on your stock can't be so low. It's got to be higher. And so if you look at PE multiples during the 70s, I mean, they contracted dramatically. And so, the S&P PE multiple right now, I think it's about 23. I mean, that could easily, the long-term mean on that's 14, by the way, just shows you how big a bubble we're in. That could easily come down to, 14. Well, if we went from 23 to 14, the S&P would be down 50% from where we are today. So, right? Yeah. And then take the margins down a little bit, and so take profit growth down a little bit. I mean, this is how the market loses 80% of its value. Mm-hmm. I mean, I talk to people every day who have enormous stock allocations, and I say, why? I mean, I don't get it. It just doesn't make any sense to me in this climate, in this environment.
So, going back to the idea of having these companies, these gold companies that have record demand. We just went through the amount of demand there is from central banks right now, and yet the the gold mining stocks are just getting kicked in the face over and over and over here.
Great question.
I just
why? How?
don't understand that dislocation. And does that obviously create an excellent opportunity for those that see it?
It creates an enormous opportunity, but most people don't believe in it. I mean, it's, the sentiment in gold mining right now, there's this thing called the BPGDM, which you can look at a chart of. I mean, it's never been worse. Let me explain to you, though, why the big divergence between the gold mining stocks and the price of gold. Because this is it's a mystery to a lot of people, and I think I've uncracked it. I think I have the answer. If you go to Bloomberg and you ask, you look at Bloomberg has 5-year out estimates, right? Mm-hmm. The average 5-year out estimate, Tom, for the price of gold is $1,750 an ounce. Okay, and we're trading at $1,900 right now. Isn't that amazing? People think, yeah, right? Okay, but that's the average. That's what the world thinks. The world thinks in 5 years gold will come down because gold's run up because of all that inflation we had.
Oh, okay.
They think it's going to come back down because inflation's going to come back down. Okay, at the same point in time, you go look at all the gold mining companies, and there's something called an AISC, and you know what that is? That's the average, the all-in sustaining cost to mine an ounce of gold. Mm-hmm. So that's kind of the gold miner profit margin figure.
It's almost the floor for what it should be, right?
It's the floor, right? So a few years ago, the AISC across the big majors, an average was maybe $1,000 an ounce. Gold was selling at, call it at the time, it was maybe selling $1,600, $1,700, $1,800 an ounce. So you had a nice profit, $600, $700, $800 per ounce that you pulled out of the ground. That works. You need that, by the way, though, because you got to you got to replace what you mined. You got exploration costs. Some of that's in the AISC, but not all. And you've also got capex to grow production and so on and so forth. So those AISC figures, inflation comes along, right, in 2020, and those AISC figures have gone up a lot. Okay, in other words, those AISCs include labor, they include oil, they include power, they include materials, they include Caterpillar trucks and all that stuff. And so those AISCs have gone from an average of maybe $1,000 4 or 5 years ago. Now they're in the 13, 14, 15. I got some companies that are $1,600, $1,700 AISC. So if you're a gold miner, you got a $1,700 AISC and you're selling your gold for $1,900, you're making $200 per ounce. That ain't going to cut it. I mean, that's, you're going out of business because you're not going to be able to, sustain yourself. So combine the Bloomberg estimate of gold at $1,750 and the AISC going up at 10% a year, 10 to 15% a year, and you can see what happens. People go, oh, I get it. AISCs are $1,400 now, and in 3 years they'll be $1,600, $1,700, and the price of gold will be $1,600. These companies aren't going to be making any money in 3 years. That's why the gold stocks have been hammered so hard. Okay, what I would submit to you is
just margin compression in a way.
Yeah, it's future margin compression. I would submit to you that, in fact, in 5 years the price of gold is going to be $3,000. And, yes, the AISCs will be higher, but the margins will be fabulous at those kind of levels because the prices, the AISCs don't go up. I mean, if gold goes from where it is now to 3,000, it's gone up 33%, but we're not going to have that big an increase in the AISCs in that time frame. So that to me explains what's going on there. But yes, you're right. It represents an enormous investment opportunity. Shameless plug for my fund. I mean, I've got a lot of companies trading at 2, 3, 4 times EBITDA with EBITDA that's growing, production that's growing, good future prospects. I mean, the miners have never been more beat up. So, I fully expect that when it becomes clear to the market that the fiscal problems that we have are not going to be easily solved, and that therefore the Fed is going to have to abandon this campaign of higher rates and go back to turning the printing press on. I think when those things become clearer, gold will take out 2,100 on its way to 3,000, and these mining stocks will explode the way they did in 2016 or the way they did in 2020. I mean, 2016, they went up 150% in 9 months. In 2020, it was similar. Mm-hmm. So, and I think that's what will happen. They're very, very volatile, and they can get hammered on the downside, but when the price of gold is going up and the money supply is expanding, you get a lot of reward on the upside too.
Mm-hmm. So obviously we're very focused on gold, Larry, but how do you feel about silver? There's
I love silver too. I love it more than gold. I mean, it's the slightly, it's a metal with dual purposes, right? I mean, so gold is better as a store of wealth metal, and so, and it took a lot of the monetary premium out of silver because stock to flow on gold is much lower. There's a lot of gold out there, and that's monetary premium is all, in my view, based on stock to flow. But as we all know, silver is much more volatile than gold. And when we're in a bull market, silver, look, gold never goes up 500%, in a 2-year period, and silver does. As we also know, silver has a monetary use, but it also has an industrial use. And there are a lot of really positive things taking place in the demand for silver market, the biggest of which is solar. And I've looked at some charts and seen some data that would suggest, and who knows, these are estimates, but it would suggest that in 5 years, to get to the kind of solar demand that China is pushing for and we're pushing for, the solar market could absorb half of the silver production in the world. Right now, it's closer to 15%. So that would be a big increase in the demand for silver, which would only be satisfied with higher silver prices. And obviously, we get higher prices, we'll mine more. But keep in mind that you don't just turn a switch and have more.
Yeah.
The process of discovering and building a mine is years, perhaps as long as a decade sometimes. So it's going to take a while till we get into an oversupply situation and the price will come back down again. So I think silver, I'm extremely bullish on silver. And I think that, gold, my projections are kind of in the next 18 months, gold goes to 3,000. And the next 18 months, silver goes to 50. Now, so that's in gold, that's up 50%. In silver, that's up 100%.
Yeah.
Right. Roughly, rough numbers.
Yeah.
And that's, frankly, I think those are just kind of jacks for openers, because if it continues and the government doesn't do something to address the sovereign debt issues, I think gold's going to 5,000 and silver's going to 200. But, that's a couple chapters out, and there are a lot of things that could happen. Central bank policy will obviously play a role here. And, to be frank, if they're able to continue to be hard asses for another, what I'm describing, I've always been early and ahead of my time and therefore wrong on an investment point of view. So what I'm describing could take another 6 months, 12 months, 18 months to happen. But mathematically, absent the government getting responsible, it seems like as sure a thing as I've ever seen, kind of in the investment field. It's a very high probability.
Mm-hmm.
So,
Larry, when we think about that dual nature of silver, do you think once it hits a particular price level that it kind of switches back to serving that monetary use to people far more than it does now? Yeah, it does. Yes, I do. It's a great point, Tom. I tell you why. Because it's every man's gold, right? Buying gold is expensive. Just one gold coin is a couple thousand. Anyone can go buy a silver eagle. Mm-hmm. Do you know what I mean? And everyone likes to hold real money. And so, yes, I do. I think there will be enormous demand from individuals to buy silver. If we were ever to have an outright currency collapse where fiat were to become worthless, and this is why I own a bunch of silver eagles personally and just have them hidden somewhere, silver would probably be your everyday currency. I'm sure I could go to a farmer and say, hey, give me some of that beef or give me some of those eggs, and here's my $25. Well, now it's $25. At the time, it'll be more, but here's my silver eagle. You know what this is. I know what this is. I know a lot of guys in the trades in Massachusetts, blue collar guys, who they take all their money and they buy silver coins because they just know it's real money. They know the money they put in the bank is going to lose value. They know that silver will be worth more over time, and they're right. They're totally right. Yeah, it just seems like an eventuality of this rebalance. It is. It's what's difficult is there's so much noise and there's so much up and there's so much down and there's government manipulation, there's government propaganda, and you just kind of got to think for yourself and take a longer view. And that's difficult. It's no fun. It's no fun watching what you own go down in value, but there's a lot to be said for dollar cost averaging on whatever you do. Absolutely. Well, Larry, as we wrap up here, is there anything else that you'd like to leave our listeners with today? No, not really, Tom. Thanks so much for the venue. You can learn about me on Twitter. I make a lot of noise. I hate the central banks. I'm not ashamed to admit that. I try not to have much hatred in my life, but there's one thing I do hate: it's central banks. I just think they've done us all wrong. So that's at Lawrence Lepard. I also have a website, www.ema2.com, which you can read my quarterly letters there. They're free. You can sign up for a newsletter there. It's free. We'll never spam you.
And then I have a fund I manage. And if because of the SEC rules, I can't take small accounts, which really sucks. I wish I could, but that's not what they let me do. But if you have 200K and you want to invest in a gold stock mining fund, I think ours is as good as anyone else out there. And, we'd love to have you join us. We've got some slots open. We don't always have slots open, but we do right now. So and
maybe another sign of the
because
times.
we're in a bear market. We've had some people leave, Tom. They've given up.
Yeah, I was going to say maybe another sign of the times, right?
Another sign of the times. Yeah, I suspect that when we get back into a bull market, those slots will fill up, and then we won't be able to take new money. So, but that's just kind of the way it goes, right?
Yeah, absolutely. So, Larry, thanks so much for your time today.
Oh, thank you, Tom. I really enjoyed talking to you as always. Yeah,
absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.